Hey everyone, Happy New Year. I hope this entertains you on your holidays. If it does, a late Merry Christmas. Like and subscribe would be nice. Now, a quick shout out today to CJ on Twitter for letting me know about this one. So let me just jump straight into Terravest because you probably haven't heard much about this one before. Terravest is a Canadian company that acquires and runs propane, ammonia, and natural gas transport vehicles and storage businesses. Think about the tanks that store this stuff and those bullet things on trucks that move these products around. So someone has to manufacture these containers. They have to maintain these containers. They have to transport these containers. And this is what the company does around Canada and a bit in America too. And yes, this is another serial acquirer. And this one is a super unsexy business, which I think is awesome, because Terravest can acquire these businesses at very attractive acquisition prices, some as low as 2.5 times EBITDA multiples. Now I'm quoting CJ here, but he's right. Who wakes up in the morning thinking, oh, you know what I'm going to do? I'm going to start manufacturing propane tanks. Nobody, that's who. So competition in this space is limited, and buying these types of businesses doesn't attract big competition. Now, Terravest was actually taken over back in 2012 by a company called Clark Inc., where the current CEO, Dustin was the vice president. I think he's been since about 2014, Terravest has diligently accumulated other players in the market at very attractive rates, implementing an acquisition strategy. Now, insiders, mostly like Clark Inc. people, have about 30% ownership in the business. I think there's really good alignment there. And if you do want to know a bit more about the history, there is a great video by an investor called Guy Gottfried on YouTube that is far more extensive than I'm going to go through here today. I'll just touch on the high level stuff, but Guy has done some serious digging and is a great resource on all things Terravest. Now, for those following along, you are probably starting to notice a trend forming with my investments that I like, and that is that they could all be described as serial acquirers. We've done Technion, SDI Group, CSAM Health, today Terravest. And if you haven't been following my channel, which is around about 20% of the people who will watch this video, I hope you enjoy my style of investing videos. And since you are new, this is what I'm looking for. I'm looking for a company that has a lot of growth with high reinvestment rates of return, either through acquisitions or internally. I'm looking for companies that have a long runway in front of them, so they'll need to probably be smallish cap companies. And I'm really looking for great leadership with hopefully a high percentage of their net wealth tied up into the business. And if you know of a business that fits these three things, please share it with me. I'll even dig into it a little bit for you, give you some feedback. Please give me a rough elevator pitch though, because that's going to help. And I'm really wanting to be on board with really great management. So sell me on the management first and then the business idea second. Now, if you are new to investing and you're looking to get started, you're going to need a broker. I use Interactive Brokers because the fees are low, they're safe, gives me access to international markets. There's a link in the description where you can try a demo account if you're wanting to get a feel for how it works before opening an account. And also in the description, there's a link to a Discord group where you can share that idea with me if you have one, and we can chat about it in there. Okay, now back to Terravest. Now, management are very focused on free cash flow for shareholders. Now, I like this in a management team. That's exactly how I would want to value the business, and just like Warren Buffett would value the business, based on the free cash flow available to owners. So the first line to investors is our objective is to grow free cash flow per share through organic growth and acquisitions. That's perfect, it's simple, and shows me management have a good understanding of what's important. It's the first line of the website, I mean. So this graph shows earnings per share and cash flow available for distribution to owners per share. And as you can see, it's sort of was flat a little bit in 2020 to 2021, but jumped up significantly again in 2022. The COVID kind of stuff slowed things down a little bit, supply chain issues. They had a few... It was more of a flat year, and I think the share price probably stayed flat for that period of time as well. But 2022 has been an exceptional year, and the history has been exceptional as well. And just quickly, sorry for if you hear some background noise. I'm staying with my family at the moment. They've got little kids, and it's just hard to get some time alone here. So you're just going to have to deal with it, just like I'm having to deal with it. So anyway, back to Terravest. I was able to have a good conversation with the CEO, Dustin, which gave me a lot of confidence in him and the direction he's going with Terravest. And a few good points that I took from that conversation were this. So the last two deals were the biggest in the company's history. Their debt levels right now are high. He's aware of it, about 3 times EBIT. but they are focused on paying that down plus getting EBIT to grow, which will naturally deleverage the business as well. They are also looking to increase their credit limit, so they have some firepower in the market if the market gets depressed, and they can be ready to go bargain hunting. Now, Dustin isn't a big fan of dividends. The company pays one, but that is a bit of a legacy decision. There's some big shareholders that want the dividend. He would prefer to have all of the available cash to deploy, but not everyone in his team agrees with this. Like I said, there's some big shareholders, they want some of that cash back. They did just raise a dividend a little bit. I think that's going to be the last raise for a while, but it's something to be mindful of in terms of if you're worried about their capital allocation and things like that. The dividend, I think, is a bad capital allocation. Dustin agrees with that. A bad capital allocation move. But it's still very minor in terms of their free cash flow available to shareholders. And something else we talked about was really the big bottleneck for this business is just finding good people to run the subsidiaries. Just like all other serial acquirers, this is just always going to be a major bottleneck. See, when Terravest makes an acquisition and the retiring business owner wants to step down, they need to fill those shoes, and that isn't easy. And then my gut feel about Dustin is he is an honest guy, loves his business. We talked a lot about the mistakes he's made in the past with deals. He was happy to own up to these mistakes. It was definitely a comfortable chat, similar to what you would have at a pub. Good guy. Since management is the most important part of a serial acquirer investment, Dustin is a good person, I think, to partner with. And I did ask him, if the business didn't exist in 10 years' time, what do you think would have gone wrong? And he said that he must have gravely underestimated the world's ability to move completely away from fossil fuels. And he followed this by saying they are moving toward more energy efficient fuel solutions and containers anyway. Luckily, most of their businesses are suitable for lots of fuel options. So he's confident in their ability to grow into renewable energy storage areas anyway. But he can't control some crazy zero tolerance fossil fuel political policy or something like that. That could obviously end things pretty dramatically. And lastly, Dustin is not even 40 yet. I think he told me he's 38, so a long runway to go there. Now, I think there are a few reasons why this business is still a good price, and here is what I think. See, because it's related to oil and gas, and it's a Canadian company, everyone will think it's an oil and gas play, which it kind of is, but they're a long way away from some of those mining companies. Now, another thing is they don't have an investor relations arm at the business. Essentially, you have to track them down yourself and do the digging. That's fine. Another thing is volatility. Well, I think that's a good thing in the space. See, Terravest have used this volatility to repurchase shares or issue tenders to raise debt. Many investors don't like volatility, but it can work in your favor if you know what you're doing, and Dustin has been able to take advantage. The free float is also small and shares trade really irregularly, and this isn't attractive for a lot of investors. Now, regarding competition from other acquirers and PE firms, see, generally the big point of difference is that the suits from the big cities don't know how to talk to these target businesses. They're rural businesses. I think Terravest is a superior buyer because they understand the industry, they understand the business, and they can give the business a good home, and the employees are going to be in good hands. They are disciplined and don't get into every deal, but I think they're the superior buyer in the market. And it reminds me of Technion a lot. It's a competitive advantage, and if you can build a good relationship with these business targets, it goes a long way. Look, there's so much more to cover here, but I'll leave that to you to dig into. This is just a starting point. So this is actually pretty easy because they spell it out for you. The free cash flow available for distribution to shareholders, add a growth rate and a multiple, and discount it back. This has been growing at, say, 25% per annum for the last 5 years, even when the pandemic slowed things down a little bit. And this isn't going to be a straight line I can project out, so it's better to play this conservatively. But 15% growth on average, I think, is very reasonable, maybe even conservative. Now, the other good thing is the consistent share buybacks, and so that is making things even better each year. So if they are acquiring businesses at less than 5 times EBITDA and buying back shares, 25% actually makes total sense. So let's do a conservative valuation, and let's even just look at what a 25% growth rate valuation might look like too. So what I've used is just that 15% growth rate out for the next 10 years. My discount rate is I'm chasing 15% with a big margin of safety, so we're going to try to get 22%. The multiple is at 15. At the moment, it's about 12, but if it's growing at these rates, I think 15 is probably a little bit of multiple expansion is fair. I've got The free cash flow for owners, the shares outstanding, the total debt, tells me about $26, around about the share price it is today, actually. Then I look at what could, if they can continue at 25% per annum for the next 5 years, and we'll slow it down a little bit after that. We're looking at buying this at $40. So it's at 26 or so at the moment. That's significantly undervalued. The return on our investment is well into the 20% per annum range here. If this situation can unfold, essentially continue doing what they've been doing. So obviously they're negatives, and here they are. See, if one of the major shareholders dumps their shares, this is going to just crater the stock, and it's because it's so thinly traded. So you have to be aware of that one. Then I think the debt levels are high, and this needs to be brought back to deleverage some of that risk. I think that's going to happen naturally, but it needs to happen. Of course, the risk is about bad deals as well. See future bad deals where they overpay for a business, or a business falls apart after they're integrating it, or something goes wrong in their buys. That's a big problem for serial acquirers. Maybe more sophisticated buyers enter the space. Then there's political risks. And one more thing is they might not be able to pass the rising manufacturing costs onto their customers. They might have some pushback there. So if that does happen, this might hurt Terravest. So we have to be mindful a little bit of that too. Now, regarding buying the shares, I use Interactive Brokers because it gives me access to Terravest. So remember, there's a link in the description for that. And then you have it. Do your own work on this one. Tell me what you think about Terravest. Join my Discord group in the description to share other ideas with me, and we can talk about Terravest as well. Hope you've enjoyed this one. Thanks for staying to the end, and I will see you next time.